This is the Asia Trade. I'm Shery in Tokyo with Haidi Stroud-Watts live at the Morgan Stanley Summit in Sydney. These are the top stories. Asian stocks set to open under pressure ahead of a data-heavy day and the double risk event of the U.S. inflation print followed by a Fed decision. Also ahead, Bloomberg reveals the U.S. is considering further curbs on China's access to cutting-edge AI chip technology. Siganti Capital and its founder Simon Sadler due to face a Hong Kong court in a few hours on insider dealing charges will be there live. Plus, exclusive interviews from the Morgan Stanley Summit, including the bank's Australia CEO and Federal Treasurer Jim Chalmers. But first, we kick things off with breaking news out of South Korea. We are getting the labor market data showing unemployment rate coming in at 2.8%, which is the same as the previous month of April. 80,000 jobs were added in May from a year earlier in the South Korean economy. The 2.8% unemployment rate is still below the average that we've got since 2020 of 3.3%. So that resilient job market number really giving the Bank of Korea some leeway to take its time before cutting rates. Take a look at how we're setting up across the Asia session right now. We had seen price data come out across the world this week. We are expecting those for Japan, India, China, and of course the U.S. CPI numbers. Sydney futures at the moment pointing to the downside. The Aussie has been weighed down by a weaker offshore yuan, not to mention lower metals prices, and the country's business confidence turning negative as well. Nikkei futures slightly higher. We had two sessions of gains already, but the yen is pretty flat given, of course, that we're headed towards a BOJ policy decision as well. Take a look at CNH at the moment, 727 ahead of inflation numbers out of China as well. But we're watching U.S. futures as well because stocks and bonds rose in the overnight session. The S&P 500 closing at a fresh all-time high. Big tech leading the gains. And Treasuries rising after that solid $39 billion sale. 10-year yields falling towards that 4.4% level, but really to do with expectations of what the Fed will do next. And of course, we're setting up for the U.S. CPI numbers as well. And the expectation is that perhaps we could get some additional reassurance for the central bank that inflation is, in fact, slowing down. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. Garfield, so what are you seeing in the bonds market right now that gives you an indication of perhaps where sentiment is going among traders?
Well, sentiment amongst traders seems to be tending towards the idea that ultimately today's double jeopardy of CPI plus Fed is going to result in what you might call a dovish outcome, that yields have mostly been headed down in recent weeks, and that trend is going to continue. We had that as the setup even before the very, very strong 10-year auction overnight, an auction that actually I think raises suspicions. So Simon White, who writes the Macroscope column and is an MLive contributor over in Europe, he was pointing out concerns about a lack of liquidity in the Treasury market, that by a Bloomberg measure, liquidity is as bad now as it has been in a very long time. And that raises the potential that part of what went on with yesterday's auction was that buyers were just very keen to get hold of 10-year notes because it's not so easy to get hold of them. So that's the sort of thing that raises the potential that there's less of a fundamental driver for some of these moves than you might think. Still, be that as it may, there's a strong expectation that CPI will come in weaker and that then the Fed will stick with forecasts for 2 cuts, and that Jay Powell will once more stress that while they're willing to be patient because they are concerned about some of the stickiness that is showing up in the inflation data, they do still expect to cut rates. In a lot of ways, that preamble that I gave, the market's not going to worry so much about that as long as they get 2 cuts forecast and Powell saying, yes, we do expect to cut rates at some stage. That's going to be enough for treasuries to extend, what's been something of a recovery recently.
Right. That's the monetary policy side of things. But this week, we've also had to contend with political risk really increasing in Europe, right? I mean, we saw that huge government sell-off of bonds in France.
Yes, ironically, this was right around the time that some people, including Bill Gross, for example, had said that on a fundamentals basis, on an economic fundamentals basis, European bonds looked attractive. You know, the ECB has started to cut rates. The BOE is expected to, probably once the election there is out of the way, and then along comes the European parliamentary elections, which are the sort of thing that often isn't on many, especially international investors, radar. It's sort of, European Parliament, that doesn't really matter, does it? It turned out to matter a lot. And now we've got some major political risks going on in Europe. That could also be part of what's driving the bid for treasuries because, well, at least for the next few months, treasuries don't face too much in the way of political risk. We'll see how things play out later on this year. This is a year we came into with a lot of expectations that there were going to be some geopolitical disruptions caused by a slew of elections, and we've got the biggest election of them all coming up in November.
I think we have about 40 elections across the world this year. Garfield Reynolds, who leads our Markets Live Asia coverage, of course, we're talking about that geopolitical risk. Well, we have another story for you. Bloomberg has learned that the Biden administration is considering further restrictions on China's access to AI chip technology. We're told officials are targeting new hardware that's only now available, making its way into the market. Bloomberg senior tech editor Nick Turner joins us from San Francisco. And Nick, we've been talking about so many restrictions against China. So how different is this time around?
Well, it's a little different than the earlier ones that really kind of focused on advanced chips, such as what NVIDIA sells or chip-making equipment that's used to make it. And this is really kind of trying to go after a chip architecture that's still kind of cutting edge and just being commercialized now and put into chips. It has potential to make chips more powerful and especially when they're applied to tasks like AI, it's the kind of technology that I think the administration would prefer not to get into potentially the hands of Chinese military or, and so it's weighing whether it wants to further restrict this technology that's really still in the early stages.
How important is for the Biden administration to implement some of these changes before the elections in November?
I think that's the thing. I mean, I don't think there's complete agreement on in terms of how to approach this issue per se. Obviously, they've been pretty aggressive so far in terms of how to restrict chips and chip-making equipment, but they want to be careful with this because there is just a few months until the election. They may only have a few more chances to sort of craft how to approach this issue. There's also some deliberations over whether to further restrict high bandwidth memory, which is the kind of memory chips made by Hynix and Micron that sort of work with AI accelerators to train AI systems. So equally important to kind of the AI ecosystem, if you will, but they're still sort of in very early stages in terms of figuring out whether and how they want to further restrict that.
You mentioned Hynix, but of course we have the likes of Samsung and TSMC as well that could be affected by these regulations. How will that play into the Biden administration's calculations when it comes to these companies that could get affected from allied nations?
I think that's what makes this a bit complicated is if this is a new chip architecture that everyone's going to kind of embrace and be rolling out, it's a little hard to restrict it the same way you would a very specific chip that's used for a certain purpose. So I think that's kind of what factors into these deliberations and how they have to figure out how to proceed. They don't want this most advanced technology to, get into what they think are the wrong hands, but also, if this is kind of the future of chip making, then it's a little hard to kind of rein in the whole thing, if you get my meaning.
On the numerous restrictions that the U.S. has already imposed, how effective have they been so far?
I think it's been a mixed bag. I mean, certainly they've the impact that we see here in the U.S. sometimes is how it's affected the sales of U.S. companies. And there's certainly been areas where revenue has been impacted. But in terms of chip-making equipment for sort of slightly less advanced chips, that's been kind of booming to China. And a company like NVIDIA basically sells everything it can make. So it hasn't really kind of been hurt in the near term. But the question is, over the long term, if it loses this valuable market, does that hurt more? And certainly it seems like it would.
Bloomberg senior tech editor Nick Turner there joining us from San Francisco. Great to get your insights as we continue to follow other geopolitical stories topping our agenda. Today, U.S. Secretary of State Antony Blinken says that Israeli Prime Minister Benjamin Netanyahu has reiterated his support for Washington's ceasefire proposal during a meeting in Jerusalem. It comes after the UN Security Council adopted a U.S. resolution backing a truce in Gaza. Israel and Hamas have so far failed to agree to terms that could lead to an end to the fighting, despite sustained mediation efforts. Premier Li Qiang is set to become the most senior Chinese leader to visit Australia in 7 years. When he arrives on Saturday, China's foreign ministry has confirmed the 4-day visit, which comes as warming ties face a challenge from renewed frictions over investment and military deployments. Li's predecessor, Li Keqiang, last visited Australia in 2017. President Biden says he will respect the judicial process and not pardon his son, Hunter, who's been convicted in Delaware of violating federal gun laws. A jury found Hunter was addicted to drugs when he bought a gun in 2018. He becomes the first son of a sitting president to be convicted of a felony and faces another criminal trial on tax charges just 2 months before the presidential election. Coming up on the Asia Trade, we're continuing our coverage at the Morgan Stanley Australia Summit in Sydney. We have plenty of guests coming up, including an exclusive interview with Australian Treasurer Jim Chalmers. This is Bloomberg. You're watching the Asia Trade. Take a look at how Treasury futures are setting up at the moment after we saw them rise for the first time in 4 sessions in New York. We had a solid $39 billion sale, so we had the 10-year yield falling towards 4.4%. We also had Treasuries being bid as political risk in Europe intensified. Of course, we had that rout in French bonds as well. We are, of course, setting up for more risk events, whether it's the U.S. CPI numbers that should give the Fed potentially some additional reassurance that inflation is slowing. And of course, eventually we do get to the FOMC. Citadel's global head of rate trading, Michael DePass, spoke exclusively to Bloomberg TV and says he expects an overreaction to the Fed's dot plot this week.
The inflation data in particular, there's a feeling that the volatility around those prints going forward is maybe going to come down. I think for tomorrow, the focus really will be on the FOMC. And in particular, what does the dot plot show for the number of expected cuts for the rest of this year? That number has obviously come down materially over the course of this year. And the market's split between, I think, somewhere between 1 and 2 cuts. So there'll be a little bit of a reaction, whatever the outcome.
How big a pinch of salt would you take when it comes to the 25 dots? The Fed's, all of our predicting capabilities have been severely tested this year.
I think you take a very big pinch of salt with anything relating to 2025 predictions. The data has confounded many people. The cycle has not evolved the way we would have thought. Yeah. It's a very different cycle than what we're used to. And I think the market recognizes that if we're talking about the 25 dot, for example, it's so data dependent. There's so much evolution that can happen to that prediction over time that it's weighted certainly less, I think, than it would have been in the past.
In terms of, so how are you thinking about the kind of the way that the arithmetic works? If we get, say we get 2 this year, do I assume that I'm getting a cycle? Or is this just a mid-cycle kind of adjustment? Do I assume that I'm going into a full-blown kind of cutting cycle here, and there are going to be more that follow? It's interesting. This is the debate that we're having at the ECB right now, and I'm just, what is your kind of current thinking about how many we get in total? Is it a cycle?
Yeah.
What makes a cycle?
Yeah. Well, the ECB made sure to stress that it wasn't the beginning of an easing cycle. They clearly want to retain optionality, and I think that's going to be the major theme out of central banks, is that we will adjust, we will respond to the data, but we want to maintain optionality. We don't want the market to get ahead of us. We don't want the market to maybe ease financial conditions in a way that's not really beneficial. So I suspect that we're never say never, but it's going to be difficult to get back to the zero lower bound. I don't think that's where we end up this cycle. I think we're talking about a cycle that ultimately looks like 200 basis points worth of easing, and probably a bit more spread out than what we've been used to over the last 10 or 15 years.
Citadel Securities Global Head of Rates Trading, Michael DePass, speaking exclusively to Bloomberg's Guy Johnson. And the latest from the corporate front as well. Oracle surged in extended trading after posting bookings well ahead of expectations. The results suggest growing momentum for Oracle's efforts to compete in cloud computing against larger rivals Amazon, Microsoft, and Google. The firm also sees revenue growth increasing by double digits in the current fiscal year, fueled by strong AI demand. Elon Musk has dropped a lawsuit alleging OpenAI and its CEO Sam Altman breached a founding promise last year. The Tesla CEO withdrew his complaint a day before a judge was set to hear OpenAI's request for dismissal. Musk did not provide a reason why. He had earlier accused OpenAI of becoming a de facto subsidiary of Microsoft. Boeing slumped in U.S. trading after delivering only 24 commercial jets in May, hampered by part shortages and fresh scrutiny from Chinese regulators. The results match its total in April, the lowest in more than 2 years. Rival Airbus delivered 53 aircraft last month. Boeing is paring back 737 deliveries as it reinforces safety at its factories. Sources say the EU is set to hold off on key parts of the long-delayed Basel Global Bank capital rules. We're told the one-year pause is to avoid the bloc's lenders being disadvantaged by wrangling over new standards in the U.S. The EU was due to bring in the wider package on January 1st, but now plans later implementation for rules affecting banks' trading businesses. And coming up, we'll be speaking exclusively with BlackRock Director Dohei Echizenya about its listing of an India ETF on the Tokyo Stock Exchange. You can catch that conversation at 8:40 a.m. Hong Kong time or 9:40 a.m. here in Tokyo. We have more ahead on the Asia Trade. This is Bloomberg.
We're here at the 6th Annual Morgan Stanley Australia Summit in Sydney, and our first guest joining us exclusively is none other than Richard Wagner, who's the Morgan Stanley Australia CEO and the co-head of investment banking. Richard, always a treat to chat to you at this event. How's business?
Good morning, Heidi, and thanks for coming again. It's great to have Bloomberg TV here.
How's business going for you guys?
Business is slowly picking up. I mean, after a couple of tough years in investment banking, I think we're seeing market conditions improve month by month. We're seeing a lot more deal activity as every month goes by. You know, the rabbit hasn't jumped out of the hat quite yet, but every month gets better.
We were talking a little bit about how the fact that you're sick of talking about interest rates, but I have to ask you, how do you assess the broader sort of macro economy and how the RBA is navigating this last part of the cycle?
Look, I think you know, the conclusion of the debate at the moment is that Australia is just lagging the rest of the world by 3 to 6 months, call it. Our central forecast is for rate cuts in the US this year, yet our house view is for cuts next year, starting in the first quarter in Australia.
How does that play into your view as to deal volumes and interest?
Look, I think it's now pretty well widely accepted by the market that that is the rate cut cycle that we'll be on. So we've noticed our M&A pipeline and our equity capital markets pipeline building over the last few months in anticipation of rate cuts.
Guzman and Gomez is one of the ones that you're co-managing. Do you think Australia's ready for the IPO window to reopen?
Yes, I do. The wall of money that's sitting on the sideline, Haidi, is unbelievable. Not only listed investors, but also private equity. And I think well-structured, correctly priced IPOs will happen. And I think Guzman will kick that off.
Do you think there's implications for capital markets if we go from already being in a per capita recession to a broader recession in this economy?
Look, I'm not forecasting a broader recession in the economy, Heidi. You look at the fiscal position of the government, it's very strong. Australia's actually, let's coin the phrase again, a lucky country. The resources revenue that we've been enjoying has meant we've been in budget surplus, the government's been spending lots of money, and we haven't got unemployment. It's slowly coming in, but not in a material way.
We've seen attempts and certainly a lot more activity when it comes to the resources sector for deals. Is that an area that you're watching closely? Are there sort of specific sectors that you think will see more activity?
Look, I think on the M&A side, I would watch sectors that financial sponsors and private equity like. For example, healthcare, some of the consumer goods, because the weight of money that private equity have right now waiting to invest and will be invested over the coming 12 months, I think it's going to be prolific. And private equity do like healthcare and consumer product, and I think we'll see activity there.
What's also been quite interesting is that shareholder activism has been making a return, even in Australia. Is that a trend that you're picking up on? Are there is there a sense that boards and companies are more aware now?
Definitely, it's a big topic at the boardroom. And look, what I'd also say is rather than activist investors, which we've seen a lot in the US, we're seeing very active long-only investors who are more vocal with their views around what they want to see from companies and boards. And I think that the temperature has been turned up and the pressure is on those companies that are underperforming, and that's been well reported in the press, and I think that'll continue. Which
companies are you watching in particular?
Well, look, I'd rather not get too specific in terms of the activism on companies. Look, we've been heavily involved in the Lend-Lease situation, and that has led to significant change, which I think is good for the company.
You know, last year when we were sitting here, the theme for the summit was beyond disruption. Do you think Australia's made good on being sort of a little bit more opportunistic about themes like AI?
Look, I think, Heidi, the AI theme is really yet to play out. It's interesting, in a few of the offshore conferences and other things, people have been asking the question as to whether there's an AI bubble. And I think the reality is that there will be winners and losers out of the AI debate. There's a lot of money being pointed towards AI right now. People are trying to work out who the winners and losers are, and without a doubt there'll be some big winners. There already probably are a few big winners that we know well. And then there'll be some losers, and people will lose money on AI because with any disruptive technology, bets are placed early without knowing the outcomes. And look, I think just listening to Cliff from Canva on stage and the amount of work that they're doing, embracing AI and embedding it in their product is a great example of Australian companies capturing what's going on in the world and making the most of it for their products.
Is there a sense that there could be more for Australia?
In terms of AI?
In terms of, I guess, capitalising more on tech deals.
Yes, look, Australia's always been a great incubator of tech companies. A number of our unicorns are now well and truly on the global stage, like the Canvas and the Safety Cultures and Rocked. And I think that will continue because we're a very innovative nation, and the number of unicorns coming out of Australia will continue over the coming years. And I think that we follow them very closely because most of them end up listing in the US, certainly the big ones, and they're very successful Australian-grown companies.
You talked about the wall of money. Do you think Australia is still attractive for investors outside?
I think it's very attractive, and I would say that given the volatility in China, most of the global money that's been pointed at Asia Pacific has been reweighted away from China, and the beneficiaries of that have been Australia, Japan and India. And a lot of money has flowed both through global funds and global private equity firms. Australia's a very safe place to do business. It's very, very hard to lose money in Australia. And therefore, that safe haven has been an attraction of capital, particularly in the last 12 months, as we've seen such extended volatility in China.
You talk about China, which is, to my next point, the Chinese Premier is set to visit. He's looking at a number of different aspects to his trip, including potentially a site of lithium in WA. Do you think these sort of cross-border deals are getting harder, though, particularly when it comes to strategically sensitive areas?
Well, I think that's a good question for the Treasurer, who's following in the interview scheduled today for you. I do think Australia is going to be very cautious on its precious metals as it relates to FIRB. And I think the government's already made that pretty clear, that their antenna's up in terms of the level of foreign ownership that they'd like to see in precious metals.
You just spoke a little bit about the deal flow when it comes to the US. Do you think the outcome of the election will change that? Is there a chance for markets like Australia to capitalise on that?
Look, I think what we're seeing now is people have been putting off doing deals because of interest rates and waiting for the cut cycle. And now in the US, people are delaying deals because of the election. And so, quite frankly, once we have a resolution on the election, I do think we'll see increased deal flow following the election, irrespective of the outcome. Just simply having the certainty around interest rates and the certainty around the election, I think, will be important for markets.
Got you talking about interest rates there at the end, Richard. Great to have you with us. Richard
Thanks, Heidi.
Wagner, with Morgan Stanley Australia CEO and co-head of investment banking. Shery.
And Heidi, of course, we're counting down to the market opens. We're about 30 minutes away. We'll be taking all of those conversations into account as we see how markets are awaiting May inflation data also out of the U.S. Bloomberg Economics says that the Fed should get some additional reassurance that inflation is slowing, helping make the case for cutting rates this year. Asia's largest economies, China and India, also reporting inflation later today. Bloomberg's learned that the U.S. is considering further restrictions on China's access to cutting-edge AI chips. Sources say the measures being discussed would limit China's ability to use a new technology that promises to make semiconductors more powerful. Sagility Capital Management and its founder Simon Sadler are set to appear in a Hong Kong court in a few hours to face insider dealing charges. The hedge fund that has since been forced to close has said it will mount a vigorous defense against the charges. And of course, Heidi, we continue to watch the developments around the India elections because a weekend mandate for Prime Minister Narendra Modi really puts into question some of his policies, right? Especially one that's meant to make India greener. And we know that he's sort of cast himself as a climate champion for much of the past decade. He even pledged to make India hit net zero by 2070. And given the fact that he's added over 100 gigawatts of renewable capacity during the past 10 years of his government is really a demonstration of his commitment. But at the same time, Heidi, demand continues to grow in India, which is growing exponentially as the economy expands, right? So coal, as you can take a look there, still accounts for roughly 3/4 of output today.
Yeah, it's such a big sort of factor when it comes to the global shift to green. But Shery, we've been talking about what a massive year it is for global elections, and we had the European Union elections, and this big shift to the far right in Europe in these results also has pretty meaningful implications in terms of the climate policy agenda there, right? This weekend's elections marking the end of the bloc's greenest parliament ever, concerns over everything from climate policies to migration, giving the populists now a boost. The biggest loser was really seen as being the Greens. The rise that we saw 5 years ago that helped the 27-nation bloc embrace what became the world's most ambitious climate strategy now kind of in tatters, if you will, from the ballot that finished up on Sunday. So we're seeing that big blow to climate-friendly Liberals from voters and at the same time those far-right nationalist parties strengthening their positions. The question is whether it's going to topple the Green Deal. That doesn't seem to be the case. We have the mainstream parties supporting that plan to decarbonise the economy across the bloc, but we could see a weakening of the resolve of governments when they try to actually implement that policy into reality. We're talking about measures that will affect households, so there's likely to be quite a bit of bickering to come, Shery.
Such an important conversation given that energy security is really a top priority, isn't it, with geopolitical risks rising across the world. Let's look closer Two technologies that are central to energy policies: solar power and carbon capture. Energy reporter Sing-Yi Ong joins us from Singapore, along with Bloomberg NEF Head of Sustainable Materials Research, Alan Tom Abraham. Let me start with you, Sing-Yi, because Shanghai right now hosting the biggest gathering of solar companies in the world at a time when, as we said, the industry is facing oversupply issues, and of course, energy security is so important. How do we see this unfolding?
Right, so there has been a rapid build-up of factories that has outpaced global demand, and that has resulted in excess capacity production, leading to falling prices and also shrinking profit margins. And so, that has resulted in solar companies having to lay off people and having to shut manufacturing lines as they grapple with falling prices.
What have we seen from China in terms of trying to ease the situation?
Right, so what the China government has done is that they essentially have tried to keep demand strong. So in a series of energy policies that have been released very recently by the government, they have tried to ensure that, solar panels demand remains strong, and they do that by reducing the renewable energy limit on energy-rich areas. So what this basically means is that more solar panels can be deployed in places that would have otherwise been deemed overcrowded. And so through policies like that, the government is trying to ensure that demand for solar panels continue to remain strong.
What have we seen in terms, Sing-Yi, of government policies, especially given, as you said, Chinese manufacturers are still calling for more intervention?
Right, so despite these policies that the government has already put out to ensure that demand remains strong for solar panel manufacturers, these solar manufacturers want to see more from the government. So they are hoping that the government could help to crack down on low prices and also to help coordinate development in the solar industry and to ensure that, companies avoid over-competition in this sector. So these solar companies, they are wanting to exit the slump that they are in. So they're hoping that the government can do more in terms of government intervention.
Let's take a look at carbon capture. And Alan, where are you seeing markets that are kind of leading the deployment when it comes to this technology today?
Thank you. Currently, the US is the leading market when it comes to carbon capture as a technology. There's about 53 million tons of annual carbon capture capacity that's installed globally, and the US accounts for about 47% of this capacity. And we at BNEF, we track about 424 million tons of cumulative carbon capture capacity annually proposed to come online by 2035. And the US continues to be the leading market there with about 39% share. The next biggest markets are the UK, the Canada, and Europe. And together, Europe and North America account for about 80% of the 424 million tons of carbon capture capacity that's expected to come online by 2035.
Alan, so how much does carbon capture actually help when it comes to getting the world on track to meet its net zero goals?
Carbon capture is, in fact, an interesting technology to get us on track for net zero. But unfortunately, we're still a long way away from getting on track for our net zero goals. In BNEF's long-term energy transition scenarios for net zero, the world needs about 5.6 billion metric tons of annual carbon capture capacity installed by 2035. That's about 100 times the capacity that's operational today. And so that shows the scale at which it needs to increase. And beyond just the scale, there's also a regional aspect to it. About 2/3 of this capacity must be installed in the Asia-Pacific region. And that's exactly opposite to what we are seeing in terms of where the activity is picking up when it comes to this technology. Almost all of the activity today is concentrated in Europe and North America, and that becomes another challenge for the world to meet its net zero goals with carbon capture.
Alan, what's holding back the scale up when it comes to carbon capture capacity?
There are several factors, but the two most important ones are cost and infrastructure. Let's start with infrastructure. When we think about carbon capture, all of the captured carbon dioxide would then eventually have to be put into a pipeline or a ship and then safely stored away in deep geological reserves for long periods of time. And this infrastructure usually takes a long period of time to build, usually about 10 years sometimes from conceptualizing to completion of these projects. And that puts a lot of challenge in building up this infrastructure. And when we look at capacity that's proposed, we see a huge mismatch when it comes to capacity that's proposed for capture of carbon dioxide compared to transport and storage, often transport and storage being the bottleneck there. And at the same time, cost is an important factor. Carbon capture is an expensive solution today. Yes, it is expected to come down in price as technology improves and as larger projects come online, which can exploit economies of scale. But in the short term, over the next 5 to 10 years, we need governments to add more incentives and also support in terms of carbon pricing in order for this technology to scale up.
That was our Bloomberg NEF Head of Sustainable Materials Research, Alan Tom Abraham, and our energy reporter, Sing Yu Ong. Well, Securities Capital Management and its founder, Simon Sadler, are set to appear in a Hong Kong court in a few hours to face insider dealing charges. Let's bring in Min Min Lo, who joins us from outside Hong Kong's Eastern Magistrates Court. So, Min Min, what are we expecting from today's proceedings?
Hey, good morning. Yeah, it's quite quiet here outside the courthouse. I think we're a bit early. We're expecting the hearing to start in about 2 hours' time, and we're waiting for the defendants to come in. We are not expecting to see a long trial today. Our sources are saying that the SFC, the Securities and Futures Commission of Hong Kong, is likely to ask to get this case moved up to the district court. The district court will be able to hand out longer sentences of up to 7 years, as opposed to the maximum of 3 years that the magistrate court can hand out. But even then, that is still below the maximum penalty that an act of insider trading can carry in Hong Kong. That's 10 years. But our sources are saying that prosecutors are not looking to push this case all the way up to the High Court. Now, the defendants, they last appeared here in court on May 2nd. They had not entered any plea, and both the founder, Simon Sadler, and the former trader, Daniel LaRocca, they're out on bail for $1 million Hong Kong dollars and $500,000 Hong Kong dollars each. So if today goes according to plan, then we want to look out for when the next hearing is and whether those two defendants, they will be able to extend their bail on the same terms.
What do we know at this point about the charges?
Yeah, we don't know a lot at this point. So there are 3 defendants, the firm Securities, as well as the founder and the former trader. They are charged with insider trading related to a block trade in 2017. But the SFC has not identified the block trade. But according to the Financial Times, this is related to a sale of a 10% stake in the fashion retailer Esprit. And according to our sources, the sale was carried out by another hedge fund called Lone Pine Capitals, and Securities had allegedly obtained insider information and had traded shares of Esprit ahead of the block trade. According to our data from the Bloomberg terminal, there were unusual price movements on Esprit's shares in the days leading up to the block trade. In the 2 days ahead of the trade, the shares had fallen by 3% per day, and on the day of the trade, it had fallen by 13%. But there are still a lot of details that we're very uncertain about, but the arguments of this case will likely focus on exactly what information was shared with Securities before the block trade, whether they knew of the scale of that trade, and whether they had acted on material, non-public, market-moving information.
What's at stake when it comes to the broader implications for the banking industry?
Yeah, I mean, this is a very closely watched case. It's a high-profile case, and I think bankers and brokers, they'll be watching this very closely because they will have to think about how they manage their relations with potential clients in the future. Because the thing about block trade is when banks are trying to offload these shares, they cannot reveal any potentially market-moving information that could affect the prices of these securities. But in order to gauge investors' interest, they will have to have these conversations with potential clients. That's where potential leakage can occur. There's supposed to have these conversations in a very vague manner, but sometimes savvy investors are able to make educated guesses about what those upcoming deals are, especially if the listed company involved is engaged in a very unique trade. And also for newly listed companies, they often have a lockup period of about 6 months for key shareholders to prevent them from selling huge blocks of shares. So banks do have a calendar keeping track of the expiry dates of these lockup periods. So sometimes it may be possible to guess, depending on the timing, what are the block trades that could be available on the table. And so this is something that the SFC has been trying to regulate, although it's received some pushback from industry players who talked about how more regulation could erode Hong Kong's place as a hub for trading in block trading, at least in the region.
I mean, when it comes to court proceedings, we usually take a look at precedents to know how they could actually unfold. Do we have any past cases that could give us an indication of where this could go?
Yeah, there had been a number of past cases since Hong Kong made insider trading a criminal act in 2003. There had been at least 10, possibly more. One of the highest profile cases was in 2009. A former managing director of Morgan Stanley was charged with insider trading. He was sentenced to 7 years in jail, although the sentence was reduced to 6 years after an appeal. But he also had an ongoing civil proceeding that was going on in parallel with a criminal charge, and he was asked to return, I think, about $3 million to nearly 300 investors. The civil proceeding took a lot longer, about close to 8 years, I think. And so that is one case that we could possibly draw reference on for what could happen with this trial.
Yeah, our China reporter Min Lo now joining us from outside Hong Kong's Eastern Magistrates Court. We have more ahead on the Asia trade. This is Bloomberg. Right, it's time now for morning calls ahead of the Asia trading day. PIMCO says it's expecting more regional bank failures in the U.S. because of a very high concentration of troubled commercial real estate loans on their books. The asset manager says lenders are selling quality assets first to avoid big losses. Uncertainty over when the Fed may cut interest rates has exacerbated challenges faced by the commercial real estate sector, leaving lenders stuck with assets that are tough to sell. Traders are rapidly unwinding bets for a rally in treasuries ahead of the U.S. CPI report and Fed decision. Futures positioning in the bond market shows higher for longer bets, overtaking optimism that the Fed will cut rates soon. A survey by JP Morgan also shows net long positions dropping to the lowest in 2 months in the cash treasury market. And of course, we continue to watch how all of that is affecting Asian assets, and we're headed towards the Australia Open. And this is the setup right now. The Aussie dollar really not doing much after we saw that downside pressure in the previous session. We did have a weaker offshore yuan, lower metal prices, and of course, Australia's business confidence turning negative, and that really weighed on Australian assets. You can see right now, Sydney futures also pointing to the downside 0.5% at the moment, while yields had held steady in the previous session as we had seen that really global bond sell-off. As I mentioned, we had really been watching not only the U.S. CPI numbers, but also the upcoming FOMC. But of course, the political risk stemming from Europe and that sell-off that we saw in French government bonds as well. Take a look at how U.S. futures are trading at the moment, because we had stocks and bonds rising. The S&P 500 managed to close at a fresh all-time high. Big tech led the gains in equities. As Apple jumped to a record, treasuries rose for the first time in 4 sessions after a solid $39 billion sale. But perhaps, Heidi, we are seeing a shift in bond market sentiment. We'll continue to watch as we await the U.S. CPI and treasuries and FOMC results as well.
Shery, Blue Owl Capital co-founder and co-CEO Marc Lipschultz says it's still a great time for private credit, even amid fears on company debt defaults and the Fed's higher for longer rate strategy.
This is a really great time in private credit. You know, I know there have been some efforts by, I might call our antagonists, to paint the picture, you know, picking little anecdotes here and there, but the reality is that we have not seen an uptick in defaults. We have not seen an uptick in companies having trouble performing. And I think that's by virtue of making really good credit selections and low loan-to-value investments.
But others might say that, unlike the public market, you don't have a Fitch or a Moody's saying that this is a default on the debt the way that they would for something that's traded on the public markets.
Well, a default would be a default in any market. You're right. We don't have the opinion of the credit lending agencies on the business. I would proffer that's one of the great advantages of our model for the user of capital. Listen, at the end of the day, as opposed to a third party, and no offense to Fitch or Moody's, they do a wonderful, wonderful job for what they're designed to do. But we're designed to provide long-term capital and make a very in-depth decision around those companies, counting on the long-term strategy to get paid back, and it works. We've done about $100 billion in loans, and our running loss rate has been 7 basis points. And so there's something quite substantial about the ability, like a long-term investor in equity, to take a long-term view of the credit, not what happened this week or this quarter, but are we going to get paid back? And the terrific news about our business is we consistently get paid back.
And Marc, though, but you do know, I mean, there is a timing for investors, that is. There is a timing issue that some of them do have to be mindful of, particularly when they need the cash for other things here. And there's been a lot of concern here that, at least coming off of those last vintages, some folks aren't getting the payouts in the time frame that maybe they had anticipated here. What do you say to those people? What do you do to actually placate them?
It's a great question, and Romain, good to see you again since our time in Milken together. It is, I think, a really great point. It says pick your manager wisely, understand their strategy, understand what you're investing for and in what structure. We've designed our firm from day one in credit to be able to serve institutions, CalPERS, CalSTRS, and individuals as true peers. They have different uses for liquidity, different needs. And so you have to be very aware, I think, of what you're investing in and what product, what structure.
Blue Owl Capital co-founder and co-CEO Marc Lipschultz there. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how Japanese futures are setting up, as we just got the May producer price number rising 2.4% year-on-year, beating expectations. The month-on-month also accelerating 0.7%. The estimate was for 0.5%, so that number is also beating expectations and showing that prices have been accelerating in Japan since bottoming out in the beginning of the year. So factory prices also gaining ground. May producer prices rising 2.4% year-on-year. This is the setup for the opens in Japan, South Korea, and Australia. We'll get you a conversation with the Australian Treasurer Jim Chalmers coming up. The market opens are next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens as we head towards key central bank decisions in Japan and the U.S. Of course, we also have inflation prints, not only in the U.S., but China, India as well. And Haidi, of course, such important data points for conversations that you're about to have at the Morgan Stanley Australia Summit.
Yeah, certainly. It is all about interest rates. It is all about inflation. As you say, India and China are the two that we're watching today. Very, very divergent paths. We're expecting a bit of a pause in the decline that we've seen in India. Of course, gold is a big part of their consumer inflation basket, and that's expected to have spiked. But watching China very, very closely, given how weak that consumer side has still been, even with all the supportive property measures.
Take a look at the open, Haidi, because the Nikkei is coming online with a 0.25% gains, while the Topics is down 0.8%. When it comes to that inflation data that we've been talking about, really a different scenario when it comes to Japan, with factory prices accelerating again. Japan May producer prices rising 2.4% year-on-year, beating expectations. This, of course, something that the BOJ will keep an eye on. We are expecting their central bank decision this week, as well as the Japanese yen holds steady. Very narrow trading range, given that we are also headed towards, of course, the Fed rate decision. Take a look at how the Kospi is coming online, because we just had their South Korea May adjusted jobless rate coming in line with expectations, 2.8%, and really at a much lower and tighter rate than we've seen it in the past few years. Really, the average since 2020 has been past 3%. So the tight labor market really expected to give some leeway to the Bank of Korea when it comes to cutting rates. You can see upside of about 0.4% for the KOSDAQ. And take a look at how cash treasuries are coming online as well in the Asian session, because we had seen treasuries gaining ground in the New York session. Of course, we have seen it rise for the first time in 4 sessions because of that solid $39 billion sale. But also we got some bidding coming from European election concerns and that sell-off that we've seen in French government bonds. But of course, Australia is a key one to watch, Haidi, down 0.2%. And you're waiting there with a very important conversation coming up.
Yes, really. The Australian Treasurer, Shery Jim Chalmers, says he's cautiously confident that the economy is in for a soft landing despite sluggish growth in the first quarter and stubbornly strong inflation. And he joins us exclusively now here at the Morgan Stanley Australia Summit. Treasurer, it's such a pleasure to have you with us.
Thanks, Haidi.
And, as I mentioned, you've got unemployment rising, you've got growth anemic at best, and quite a lot of stickiness when it comes to key parts of inflation. Is there any worry for you that we're headed towards even a mild form of stagflation, 70 style?
Oh, that's not our expectation. We do have a remarkably resilient labour market still, and that's one of the big differences here. We'll learn more about our labour market tomorrow when we get our labour force data. We have had slower growth, but we've had inflation moderating to almost half what it was 2 years ago, less than half what it was at its peak. So we've got moderating inflation, we've got a resilient labour market, we've got relatively weak growth. And in all of these circumstances, it was really important in our budget that we carefully calibrated our fiscal settings to respond to those economic conditions and those economic challenges. And I'm confident but not complacent that we can achieve a soft landing here in Australia on that narrow runway that our Reserve Bank Governor has described.
And the energy rebates obviously were a core part of your budget recently. Do you expect that's going to give the room for the RBA to start cutting?
Oh, well, it remains to be seen, and I try not to predict or preempt decisions taken by our independent central bank. My job is to focus on the fight against inflation. We've made welcome and encouraging progress on that front, but as we're seeing around the world, inflation doesn't always moderate in a perfectly straight line. It zigs and zags. We're seeing that in the US and elsewhere. And so overall, inflation has moderated considerably, but we need it to moderate further and faster. Our budget will help play a role in that by the way we've designed our cost of living help to take the pressure off inflation, and also the responsible way that we're managing the budget. The bottom lines in our budget are substantially stronger than they were a couple of years ago, and that's important too.
You just referenced the zigs and zags that we've seen when it comes to kind of a structural uncertainty that we've played out, that have been played out for inflation. How fine is the balance of risks for policy making?
Oh, there is a balance that needs to be struck responding to these risks in the economy. As you said before, rightly, we've had slowing growth. Consumption is especially weak when it comes to discretionary spending. Our labour market is a little bit softer but still remarkably resilient. So we need to balance all of these considerations, all of these factors and influences, including global influences, China and the US and around the world. And in doing that, what we're trying to do, and what I'm confident we are doing, is we are fighting inflation without smashing our economy. We're achieving that balance pretty effectively so far. But there are no shortage of challenges in the economy, global and domestic, and we're cognizant of those too.
Is it a risky time to be running a pro-cyclical campaign or policy at this point? Does that make it sort of harder potentially if there is a risk of a downturn?
Oh, I don't see it the way that you've described it. And our Reserve Bank Governor was before the Parliament last week and said that the fact that we had turned 2 very big deficits into 2 substantial surpluses was helping in the fight against inflation. We've made really quite substantial progress, historic progress in budget repair, and that's helping in the fight against inflation. And our overall approach, which has been responsible, the way we've designed our cost of living help, our budget is taking the edge off inflation rather than adding to it. The budget is not the only influence, obviously, on our monetary policy, on our interest rate settings, or indeed on our trajectory of our inflation, but it does have a role to play, and we are doing our bit.
Do you think this is a time where we need to see more revenue raising by Australia? Would you see at some point a broadening of the tax base, for example?
I think in any budget you need to do a combination of things. You need to make sure the revenue base is sustainable, and we've done a number of things over the first 3 budgets of our government to make the tax base more sustainable, to pay for aged care and disability care, and pay for the debt, the interest on our debt, pay for defence and health care. These big pressures, structural pressures in our budget, we are making our tax system more sustainable to help pay for that. But we're also finding savings in our budget, almost $80 billion in savings. We're also banking the majority of the upward revisions to revenue to make sure we're getting the budget into much better condition. And all of that together helps to make room to fund our priorities, to pay down debt, and also to buffer ourselves against some of this global uncertainty that we're seeing.
And on the monetary side, are you happy with Michelle Bullock and the job that she's doing? It's been about 9 months now since she's taken the helm.
I'm obviously very proud of the appointment that we made, Governor Bullock, and I think people are seeing some of the reasons why we're proud of that appointment. The clear speaking, the communication has been an important part of that, but it's not really for me to kind of engage in an ongoing performance review of Governor Bullock or any other governor in our system. The governor does her job independently. The Reserve Bank board takes decisions independently from the government, but we are doing our bit in all of the ways that you and I have talked about today.
It's going to be a busy weekend with the Chinese Premier's visit. What are the economic stakes for Australia?
Well, obviously, this is an incredibly important economic relationship for Australia. And Premier Lee's visit will be a really welcome opportunity for us to continue to engage, to continue to stabilise a relationship which has no shortage of challenges and complexities. It can be a complex relationship to manage, but what we've shown, I think, in the last 2 years is that by engaging, by standing up for our interests when it's necessary to do so, but also looking for ways to engage and stabilise the relationship, there can be good economic dividends from that. We're very pleased to see almost all of the trade restrictions lifted over the past couple of years. That's important for our employers and our industries and our exporters. We recognise and understand how important that economic relationship is, and Premier Lee's visit will be an opportunity to advance that even further.
We were talking about the inflation numbers for China, and obviously for Australia, we're closely watching the developments when it comes to the economic recovery. What we hope is an economic recovery. Do you think the recovery is on foot? Do you think the property sector is at least out of structural levels of direness that we've seen? And do you think that translates to still a longer-term demand for Australian commodities?
Well, certainly we've acknowledged and understood and felt some of the weakness in the Chinese economy in recent times, recent quarters. And that won't fix itself overnight. Even with some of the interventions by the authorities, we're still seeing some underlying weakness in the Chinese economy, and that does impact on our commodity prices and on our economy more broadly. So we watch that very closely. If you think about the global economy, it's a mixed bag. China has been a bit weaker. The American economy has been a bit stronger. Canada's got higher unemployment. Europe has seen almost no growth, and so altogether, this is a difficult global environment to navigate, and again, it's why it's so important. We engage with our trading partners, we get the budget in better nick to buffer ourselves against this global uncertainty. We fight inflation without smashing growth. All of these conditions we're seeing around the world and around our country justify the approach that we've taken in our budget.
There's been quite a bit of interest around Northern Minerals and the shareholders thereof. How much do you engage with, or I suppose how do you engage with China when it comes to strategic minerals, given that we know that the Premier is likely to visit a lithium mine in WA?
Yeah, I mean, we've been very upfront about our interests here, and where we need to advance our interests, we'll do so, whether it's in the Foreign Investment Review Board process or in other ways. We see critical minerals really as the opportunity of a century for Australia. There's a lot of interest from around the world, not just from China, in our critical minerals, and that's because they are such a crucial part of the future economy. And so my job, in addition to engaging with the Chinese and in addition to making sure that our foreign investment regime is robust and implemented properly, is to make sure we make the most of this critical minerals opportunity. We want to make Australia an indispensable part of the global shift to net zero, this big energy transformation that's happening around the world, and critical minerals are an important part of that.
China could make or break that, though, if you take a look at the Indonesian nickel impact on Australia's nickel boom, of course. If you can't beat them, do you join them? Do you work together with Beijing?
Obviously, there have been some concerning developments in the global nickel market, you know, we've been upfront about that as well. We engage with our own exporters and employers, businesses substantially on that question. We want to make sure that these global markets for critical resources are operating efficiently, and we want to make sure that Australia is a successful part of that.
Clearly the antenna's up there when it comes to, you know, foreign interests in strategic areas of investment. Is this something that's going to be a key focus, do you think, going forward?
Well, when we announced our changes to the Foreign Investment Review Board process, the regime, we made it very clear that in some areas we'll be strengthening the regime, in other areas we'll be streamlining the regime. Whether it's critical infrastructure or critical minerals or critical technology, obviously, like any country, we'll be looking to strengthen that regime to make sure that any investment in those critical areas is in our national economic interest.
There's already been a number of overtures in the setup to Li Tang's visit in terms of reducing the tariffs and sort of smoothing out that relationship. Do you think that relationship is on a steadier footing? What are you hoping to take away from the visit?
Certainly the relationship's on a steadier footing, but we are not naive or unrealistic about the challenges of managing what is a complex relationship in our region. We've been upfront about that as well. Our job is to engage, to do that in a meaningful and respectful way, to speak up for and stand up for our national interests when that's necessary, but overwhelmingly to manage that relationship in the interests of our people and our economy. And I think we have made some good progress there. And we see Premier Lee's visit as an opportunity to advance that progress even further.
You've also said that Australia will be fine in the case of another Trump presidency, but, you know, history tells us that left-leaning governments tend to, you know, fare not that well under Trump in terms of a global context. Are you wargaming for, you know, what might happen? Obviously, with respect to what could happen with America's policies towards China, Australia is a vulnerable proxy there too.
Well, a couple of things about that. I mean, obviously we follow the political developments in the United States very closely, as everyone does around the world. But we are confident that the relationship will be strong no matter who the Americans choose to lead them. We play the cards that we're dealt when it comes to decisions taken by democracies around the world, and we will engage enthusiastically with our American friends no matter what the outcome of the election is. And I think what we showed when President Trump was president last time is that Australia has an important role to play in that relationship. When it comes to the description that you applied to our government, I see our government as a real centrist, middle-of-the-road government, taking decisions in our national economic interest, not overloading on ideology in either direction. And I think that is a useful way to think of us, and certainly that's the way that we engage with friends around the world.
Treasurer, it's a pleasure having you with us. We appreciate your time. Australian Treasurer Jim Chalmers with us on the sidelines of the Morgan Stanley Australia Summit here in Sydney. Shery.
And Haidi, of course, our live coverage will continue there in Sydney. We will also be speaking to Senior Advisor Robert Feldman about his outlook for Japan's economy next. But first, take a look at how some of the big movers across the Asia trading session are looking. We're watching Asian chip makers as Biden administration is now considering further restrictions on China's access to chip technology used for artificial intelligence. That's according to people familiar with the matter. A little bit of a mixed picture across Japan and South Korean assets. But we're watching Samsung Electronics very closely right there, because we're now hearing from sources that it's combining two North American research centers focused on artificial intelligence technology, and also hiring an ex-Apple executive to run the new group. And Of course, Apple suppliers have been in focus for a while, and we'll be watching them very closely today because we had Apple actually rising to a record high overnight. There was a little bit of disappointment at first on that AI announcement, but we are now seeing the boost in shares. We have more ahead. This is Bloomberg.
We're back at the Morgan Stanley Australia Summit in Sydney. Central banks in focus this week. Decisions ahead from the Fed, the BOJ and the Bank of Thailand. Economists are expecting the Japanese central bank to talk about cutting bond purchases and potentially lay the groundwork for raising rates next month. Let's talk about this with Robert Feldman, who's a senior advisor at Morgan Stanley MUFG Securities. Robert, great to have you with us. What are your expectations from the BOJ this week?
We don't expect them to do another rate hike this time, although they may come out with some statements suggesting that they are very serious about their expectation on the increase of prices and wages. That'll be a signal that they are actually on track for the next rate hike, which we expect to come in July, from 10 basis points now up to 25.
What are the pressures and the complications around the weakness in the yen?
The yen obviously is a major issue for the economy, and there's really a big debate. Some former Ministry of Finance officials have been saying BOJ should raise rates. The yen is far too weak. The negative impact on the economy on income, for example, from the weak yen raising energy prices is much too strong, etc. The BOJ is saying, wait a minute, if we hike rates, that'll have many other effects on the economy, might constrain investment. So we need to be careful about that. There's a huge, huge debate on this right now.
Japan has just been such a market darling for the past year. What are investors and clients asking you at the moment as to, what is the next thing to look out for? What is the next leg of this rally?
The thing I think is crucial, first of all, BOJ policy in the yen.
Yeah.
But the second thing they ask about most frequently is it real? Is this resurgence of Japanese corporate governance improvements? Is this going to be with us for a long time? Will we see call it a paradigm shift in the way that the Japanese economy is operating? So that's the question I get. My answer is yes, because of some changes in geopolitics right now, but also because of the labor shortage, which is very, very serious, pushing wages up, particularly wages for part-timers. And so those are the things that I think are on clients' minds right now.
You've talked about this as being a generational shift, that this time is different. What are the characteristics of this being self-sustaining?
Well, one is that the labor shortage is so severe in really two aspects. One is that there just aren't enough people. If we go for the next 30 years, the Japanese labor force is set to shrink by about almost 1% per year. And that puts huge, huge pressure on companies. How do you do personnel policy? The other thing is a skill shortage, because with technology changing as fast as it is, we're looking at the need to reskill a lot of people. The central number from a McKinsey study was that Japan will have to retrain about 11 million people over the next over this decade. The aggressive is 30 million. That's not easy to do, and so that the technology transformation is another one that I think is driving people's interest now.
An aging population, falling birth rate, those demographic issues not really just confined to Japan, right? What is there in terms of lessons that the rest of the world can take in terms of longevity policies that we're seeing in Japan?
Thanks very much. I'm glad you asked. I just wrote a paper on the matter. One of the things that I think is extremely important is that you need to connect the longevity issue to the fiscal issue. As populations age, as longevity rises for every segment of the population, we're looking at higher costs for medical, for pension. Where will Japan find the money to do that? Really, the only answer is through higher productivity growth. And so that productivity agenda, usually considered to be something about growth strategy, et cetera, is really very closely connected to the longevity issue. And that's something that I think needs a little bit more focus, particularly issues like getting exercise, preventive medicine, better nutrition, things like that.
Going back to the BOJ that needs to really contend with all of these issues when it comes to really being able to achieve that wage growth and sustainable demand-driven inflation, what are the chances that we might see potentially more weakness in the Japanese yen if the BOJ does not act, especially not only on hiking rates, but perhaps on debt purchases?
I think the issues there for the Bank of Japan are to balance the various issues that are involved. It's a very complicated issue. And the debate is picking up on that, as I mentioned before. And I think the issue is whether we develop a wage price spiral. If we see wages and prices both going up, wages more than prices, that would be, I think, very positive for the economy because it would aid purchasing power, aid consumption, which is a little weak this year, probably better next year. So I think those are the issues that BOJ needs to watch. And we have some very good signs from the spring wage results this year. Indeed, at a speech given by Governor Ueda a couple weeks ago, he noted that the increase of wages for part-timers is higher than that for full-timers. And that suggests that this labor shortage is raising wages faster than prices. That said, we need to confirm that in the wage data that will be coming out over the next few months.
What could derail this narrative?
I think there are many things that could derail it. One is that the wages might not come through. Another is that the skill shortage might not be solved by some of the programs that they put in place for people to reskill themselves. It turns out that Japanese post-college have the lowest level of retraining of any country around the world. I was shocked to hear this, but apparently it's true. So we need to get those, call it structural changes in labor markets, in consumption going. We also need to have companies step forward and be more aggressive about investing in AI and other IT technologies. They've already raised the amount of investment in those technologies quite substantially, but there's much more to be done in that and the retraining so people can use the technologies.
Robert, really great to have you with us. Robert Feldman, who's a senior advisor at Morgan Stanley MUFG Securities. We continue in our live coverage at the Morgan Stanley Australia Summit. Today we'll be asking their head of Australian Wealth Management, Rebecca Hill, about her outlook for the industry. That's at 8:30 a.m. if you're watching in Hong Kong, 10:30 a.m. here in Sydney. This is Bloomberg.
We're getting breaking news out of the IMF. It's now expecting China to reschedule Argentina's swap line repayments. Javier Milei's government reached a staff agreement with the IMF last month, and the IMF now expects China to reschedule those swap line repayments with Argentina. And of course, we had seen Milei winning support from IMF staff to unlock about $800 million in an economy that, of course, has been battered by political turmoil as well as economic turmoil. Now, this staff-level agreement had happened between Argentina's economy ministry, the central bank, with IMF staff in Washington. So we are now hearing that the IMF expects China to reschedule the swap line repayments. We have more ahead. This is Bloomberg. This is the Asia Trade. We're about 30 minutes into the trading day in Tokyo, Seoul, and Sydney. The top stories that you should know at this point. Markets awaiting May inflation data out of the U.S. Bloomberg Economics says the Fed should get some additional reassurance that inflation is slowing, helping make the case for cutting rates this year. Asia's largest economies, China and India, also reporting inflation later today. Bloomberg's learned that the U.S. is considering further restrictions on China's access to cutting-edge AI chips. Sources say the measures being discussed would limit China's ability to use a new technology that promises to make semiconductors more powerful. Seganti Capital Management and its founder Simon Sadler are set to appear in a Hong Kong court in a few hours to face insider dealing charges. The hedge fund that has since been forced to close has said it will mount a vigorous defense against the charges. For more, Bloomberg's Min Lo joins us now from outside the city's Eastern Magistrates Court. Min, so this is one of the highest profile cases in Hong Kong when it comes to those charges against a hedge fund. Tell us a little bit about what's at stake, not only for firms, but investors and perhaps a broader industry.
Yeah, indeed, it's a very closely watched case because it is quite rare for criminal proceedings to be brought against such an important firm. This is, in fact, one of the largest and oldest hedge funds in Asia. They had managed close to $5 billion in assets as of end of March. And also the founder, Simon Sadler, he's a big name in the industry. He is known, in fact, as the block trade king of Asia because he has built out these solid relations with big banks in the region. Seganti is often one of the first companies that banks would call when they have to offload huge blocks of shares. And, you know, this company, it has operations in London, New York, Dubai, and Hong Kong. It counts among its investors sovereign wealth funds, global pension funds. So many people could be affected by the closure of these funds because the company had said that they will be returning investors' money in an orderly fashion. But that was after they had received huge requests for redemptions, up nearly $1 billion worth of redemptions, that prompted the company to quickly send out a letter to investors saying that they will halt these redemptions immediately, but that they will return the cash over time. Now, there are also about 140 staff of the company that could be affected by the closure of the funds. We are not sure at this point what would happen to the company, whether, for instance, it could be converted into a family office to just manage the personal funds of the founder. We know, though, that the founder, Simon Sadler, he's likely to still remain quite rich, even with the closure of the fund. He's estimated to have, we've just heard that one of the lawyers actually is arriving right now. Yeah, she's just coming through the corridor, but we don't have any sight of the defendants yet as of now. But as I was saying, that Simon Sadler, he's likely to remain quite rich. He has an estimated net worth of over $300 million. He has close to about $290 million invested in the fund itself. There's our reporter over there speaking to one of the lawyers. We have to see whether she'll tell us anything about the case.
Tell us a little bit, Min, about
Heidi,
what we can
Shery?
expect in today's proceedings.
Yeah, we are not going to expect a long trial. As you can see outside the courthouse here, it's still quite quiet. Not a lot of reporters waiting outside, and perhaps it's because it's taking place at the magistrate's court, which is where these criminal proceedings tend to begin. But we're not expecting, a verdict out today. We've heard that the SFC, the Securities and Futures Commission, is likely to ask to move this case up to the higher court, to the district court, which can hand out longer sentences of up to 7 years in prison, as opposed to just 3 years in prison that the magistrate court can hand out. But that's still below the maximum penalty of 10 years for insider trading. But our sources are saying the SFC is not looking to escalate this case all the way to the High Court. We want to look out for when is the next hearing date, if all goes according to plan, and also whether the defendants will be able to continue to extend their bail on the same terms.
Right. Our China reporter Min Lo there with the latest updates when it comes to that court case. She's reporting from outside Hong Kong's Eastern Magistrates Court. And perhaps more challenges for hedge funds across China. Regulators considering tougher restrictions on how banks sell financial products to the public. Now, this move could cut off a major distribution channel for some of the nation's largest hedge funds. That's according to people speaking to Bloomberg. Regulators from the National Financial Regulatory Administration is now seeking feedback from commercial banks on revisions that would ban, quote, disguised selling of so-called private fund products, a category that includes hedge funds. Right, and turning to Australia's wealth segment, Capgemini Research Institute's latest World Wealth Report put Australia among the best performers in the APAC region for wealth growth in high net worth individuals, Haidi.
Yeah, that segment's seeing growth of, in 2023, I should say, of almost 8%. Let's talk about this with Rebecca Hill, Head of Wealth Management Australia at Morgan Stanley. So looking at the numbers when it comes to the interest in Australia and the growth of the pool of capital here, is that what's being reflected in your business?
Yeah, absolutely. Look, we're really excited about the growth, Heidi, in Australia, in particular in terms of high net worth and ultra high net worth investors. As you mentioned, it's one of the fastest growing regions in the world, and we really want to position the business to be taking advantage of that longer term.
And how do you do that in terms of what's differing in your strategy here versus, say, your competitors?
You know, obviously I'm a bit biased, but Morgan Stanley, I think, you know, we have the #1 equities franchise globally. We're the largest wealth and investment manager in the world, and we've got a leading investment bank. That integrated offering is truly in a class of its own, and bringing that to our wealth clients is very powerful. More specifically on wealth management, one of the exciting things we're doing in the US, which will come to Australia in time, is technology and AI and what that means for our clients and advisors.
How does the landscape for wealth management differ in Australia, and how does it compete, I guess, to sort of more global markets?
It's a really good question. You know, Australia is a more maturing market. We're starting to become more sophisticated as investors, but it's still very early days. Other regions are a little bit more established in that, so it's a real opportunity for us to bring some of that leading ideas that we have and we've learnt from overseas markets to Australia.
Where specifically are you seeing the growth coming from in terms of the Australian market?
It's really just as businesses continue to grow, the economy continues to grow. You know, there are business owners that are having liquidity events. We're just growing our national wealth, and that feeds into Australian net wealth as well.
You talked about, obviously, the exuberant interest in themes like AI and robotics and technology. Is there a sort of what to invest in Australia? What are the options for them to invest in when it comes to those themes? Because domestically, we're often seen as a bit of a laggard when it comes to those policies and those innovations.
You know, it's very much a global theme for us. So there are ways for investors to tap into that in other markets, be it through the US, Europe, or other parts of Asia. So where the investment opportunities might be a little bit more limited in Australia, but I think Australian companies are going to be leading at some of those at the forefront, but very much tapping into other asset classes offshore.
Yeah. Private credit has obviously been the other area that's seen so much interest. Wealth capital has been one of the pools of liquidity that we've been talking about. Do you think, is that being reflected in the interest that you're getting here?
Yeah, absolutely. All of our clients, they're very much focused on the alternative asset class as a broader class, but private credit is having its sort of golden age at the moment. And, you know, that's because banks and the regulations are increasing there, so you've got private funds that are really filling that gap. So our investors, you know, with higher interest rates are really looking to tap into that as well.
Are the risks being well understood?
Look, as all different asset classes, it depends on your risk appetite. So I think the importance really is getting financial advice, truly understanding what those risks are, because they are different to having credit from a bank as opposed to a private credit provider.
Where are you seeing, you know, other than the fact that obviously it's the sort of flavour of the month, where are you seeing that demand for interest in private credit actually come from?
It's across the board, and I think it generally is. It was first driven, obviously, being in a higher interest rate environment and the returns that are happening. But as I mentioned before, just really that pool of capital is not being provided now by the banks, given the regulation. So private investors, be they the asset owners, the superannuation funds, the private smaller investors, that's where the pool of capital is coming from.
I want to talk a little bit more about the business. Headcount, are you going to add some, do you think, for Australia?
Definitely. Look, we want to grow, we want to be part of the market here, but we're very conscious of growing with the right headcount. So it's about the people that fit us culturally and are really going to help add scale to our business in the right way.
Are there uncertainties when it comes to the broader macroeconomic outlook in terms of how the business performs over the next few years?
Not so much the business. I think the great thing about wealth management, and we see this globally as well, whether it's a positive cycle or a challenging cycle, investors always want financial advice. So the wealth business benefits from that. I do think, yes, we've been in a challenging market period and it is a growth adjustment happening. But I think we're starting to see and hoping by the back end of the year, and certainly our house view is that we'll start to see the Fed cut rates, Australia in the new year. That policy certainty really helps support investor sentiment.
Yeah, that's kind of been the theme coming up. It's the certainty as to, either politically or when it comes to monetary policy or fiscal policy. When it comes to the strategy that you've been applying for the Australia business, is there any takeaways that you think would be useful for other parts of the business globally?
Yeah, look, it's a bit of, we take a lot from what happens globally, but also for our business here, we've done a real strategic pivot to focus on high net worth and ultra high net worth investors. And one of the speakers at our summit today mentioned being really focused on what you do exceptionally well and getting better at that. And that's where we think we do the best, is focusing on those clients. So for us, it's about making the right investment decisions in the business and really creating that nimble, scalable business for the benefit of the clients.
What is the one thing that your clients are asking at the moment? What is sort of the most top of mind or most concerning, do you think, for the client pool?
I think it's really that global macro outlook is when do we start to feel more comfortable that we're getting, more certainty in the market? When do I kind of deploy more of my cash into assets, the alternative investments?
Is there a lot on the sidelines at the moment?
There isn't as much as there was probably 12 months ago, and we're increasingly seeing sort of cautious redeployment of that, but it is very much about wanting to see a few more certainty around the policy direction.
Rebecca, really great to have you with us. I appreciate your time. Rebecca Hills, Head of Wealth Management Australia at Morgan Stanley. And coming up next, we'll be speaking exclusively with BlackRock as they list an India-focused ETF on the Tokyo Exchange. This is the Asia Trade on Bloomberg.
You're watching the Asia Trade. BlackRock's iShares Nifty 50 Indian Equity ETF, which invests in Indian stocks, has just debuted on the Tokyo Stock Exchange. Joining us exclusively to discuss is Dohei Echizenya, BlackRock's Director for Japan Client Business and Wealth Retirement Solutions. Dohei, great to have you with us in the Tokyo studio. So I have really seen a lot of my friends here in Japan talk about India ETFs. It's been going on for years. Tell us a little bit about the appetite that you're seeing out there.
Okay, thank you, Heidi, for having me from BlackRock. I can tell you from the two angles why India and why ETF. Why India? I think the story is very clear and apparent and very understandable. So India has been exhibiting strong economic growth, and this growth is backed by very clean, long-term trends. First of all, you all know that the population of India is growing, and under 50% of population is 25. So a very favorable demographic story. And also, there's a trend of rewiring or refurbishing of a global supply chain. So corporations, they're seeking to move their operations into much friendlier geography. That's a second point. And thirdly, the nation's government has been spending capex increasingly to have much better infrastructure.
We have seen really a lot of people pour into Indian ETFs, especially with that expectation that Prime Minister Modi was going to have a landslide victory, but we didn't necessarily see that materialize. If you're talking about perhaps the optimism over some government policies, is there a concern that that might be dampened by the fact that he's received a somehow weakened mandate?
I would say story tells you that. So in the last 5 episodes for the election from 1999, so India equity has been showing improving return, especially after the 6-month period, right after the election. So I think it's not very dissimilar from the past. And also, I would want to explain express why India, why ETF. So ETF gives you market access through a transparent, diversified portfolio, and it comes with liquidity. And when you think about Indian equity market, it's one of the highly volatile emerging market. This is true. And secondly, investors, especially retail investors, have limited access towards the market. And thirdly, I think if you're retail investors, you will have harder time gathering information around individual companies or individual stock. That means, all in all, it really makes sense for investors to utilize index investment ETFs as a vehicle.
What gives BlackRock a competitive edge over other ETFs focused on India?
So if you think about India or any other region, so if you step back, Asia market, India or Japan market, we're providing market access for investors to build or to construct a well-diversified portfolio. So it's not about specifically towards India, but rather we are providing market access with a transparent vehicle to construct a well-diversified portfolio to both institutional and retail investors as well.
When it comes to India ETFs, how do they compare in appeal to, say, broader emerging market ETFs?
India market versus emerging market. So when you think about anyone's portfolio, you would want to have well-diversified portfolio with global equity as well as global fixed income. So we're not just not only offering investors specified or specific exposure A versus B, but rather we want to offer a set of product ranges to build your asset over time through constructing a whole portfolio.
Tell us a little bit about the understanding the Japanese investors, especially retail investors that you mentioned, have when it comes to investing in the markets. And is this becoming a more prevalent culture where everybody is trying to get their assets in and buy ETFs, especially given that we have an aging society that needs more money for retirement?
So the Japan government, led by Prime Minister Kishida's leadership, so the government have a revamped Japan NISA program. And the government is aiming to mobilize over $1 trillion household savings into investment. And we also have seen a little bit of green shoots of that mobility. So if you look at, so we have seen money pouring into low-cost index, and we understand that over 90% the destination is global equity as well as U.S. equities. And if you step back, I think BlackRock would want to think about how we can help those people, these people, to become or experience financial well-being. I think the solution is providing better services, providing better solutions, or work through our business partners, them to provide better services and better solutions. And ETF is a critical building blocks to construct the whole portfolio.
When it comes to these measures that the government has taken, or the Tokyo Stock Exchange as well, including, of course, the NISA accounts, we continue to see this optimism about perhaps a reform happening in the markets that really can return more to shareholders. Do you see that optimism and that sort of exuberance domestically as well from investors that perhaps are more interested now in the Japanese stock market, not just going overseas?
Definitely yes. So ETF act as a vehicle to move exposures instantly, but we would expect more demand to come. Both in domestically and outside of Japan through actively managed mandate or fund as well. And I think that's a testament of investors, showing more interest into more individual corporation, Japan corporation as well.
Dohei, Echizenya, great to have you in the Tokyo studio talking us through that launch of the India ETF by BlackRock, his client business department and wealth retirement solutions at BlackRock. We have more on the Asia trade. This is Bloomberg.
The latest corporate stories that we're following, Oracle surging there in late trade. As we continue to watch for that market reaction when it comes to Oracle posting bookings well ahead of expectations. Results suggest growing momentum for the company's efforts to compete in cloud computing against larger rivals Amazon, as well as some of those other competitors. We see Oracle just jumping after the results there. The deal's really validating their efforts when it comes to the cloud. They've increased by double digits in the current fiscal year, fueled by strong AI demand.
Elon Musk has dropped a lawsuit alleging OpenAI and its CEO, Sam Altman, breached a founding promise last year. The Tesla CEO withdrew his complaint a day before a judge was set to hear OpenAI's request for dismissal. Musk did not provide a reason why. He had earlier accused OpenAI of becoming a de facto subsidiary of Microsoft. Take a look at how futures are setting up. We had seen the S&P 500 reach another record high. U.S. futures not really doing much, but of course we're watching A50 China futures as close to the downside. We are watching for those China price numbers, perhaps seeing lingering deflationary pressure in the next half hour or so. But more importantly, we have heard from sources that Chinese regulators are considering tougher restrictions on how banks sell financial products to the public. The China Show is next. This is Bloomberg.